All you need to know about stock investment.
The most important thing for personal finance and retirement planning is investment. Only 20% of your wealth comes from your salary, while 80% of your wealth should come from long-term investment. Of all the investment vehicles, stock investment is the easiest one to start with. There is no capital requirement for stock investment. You can just start with $1,000 and grow to a $1 million account. However, it's very difficult to consistently make profits in the stock market. You need to know the best ways for stock investment. There are 4 factors to consider for any investment: risks, returns, efforts, and time. It also applies to stock investment. If you are investing in the stock market, you are looking for great returns. Otherwise, you can just put the money in a savings account or bond. There are hundreds of stock investment methods that people have tried, but most of them have been proven to be ineffective. Some investment methods were successful, but when more people understand and use that method, gradually, it will not be as effective as before. One example is traditional Benjamin Graham's value investing, cigar butt investing, or net investing. The approach focuses on buying beaten-down companies trading below a conservative assessment of their liquidation values. In many cases, if you sell the whole company right now, it will still be much higher than the current valuation and stock price. It doesn't make any sense. But it does exist in extreme markets, and most commonly seen in history when people didn't have good access to company-related data. Now everybody can easily find all the information using Yahoo Finance or Finviz. You can't find many good quality net stocks anymore. Another good example is when Dow theory and technical analysis were firstly introduced. It was extremely effective to make money. Many traders have achieved great success with technical analysis. However, things have changed now. Most traders lose money by using simple technical analysis alone. There are many other investing methods, like turtle trading, gap trading, grid trading, average down, pattern trading, moving average, Ichimoku cloud, Bollinger Band, seasonality trading, long-short trading, covered sell, etc. You can't use those methods alone to make consistent profits. The result could be random. In fact, most successful trading methods are proprietary and kept secret to make it effective. In modern times, there are many big institutions with the best artificial intelligence algorithms, integrating all the fundamental, financial and economic data, all the trading signals and technical indicators, and all the detailed transactions from retail investors. It's very hard to say how long it will take for those successful trading methods to become invalid due to artificial intelligence. It could be very hard to win the trading game anymore. So, you would ask if there is any way that you can make money consistently in the stock market? Let's review the 4 most important factors for investment: risks, returns, efforts and time. If you want to make consistent profit, it means the risks should be low. Based on a lower risk profile, you need to either take great efforts or take longer time. There is no other way around. You already know the best and easiest way for stock investment. Invest the same amount of money each month to an ETF tracking S&P 500 index in your Roth IRA or TSFA account, with dividend automatically reinvested, for at least 30 years. The reason why you should invest in a tax-free special account is that when you withdraw the money, it doesn't count as your income. You can save a big amount for tax, and you could be considered low income and enjoy all the social benefits. There are no efforts involved, but it takes a long time to help you go through a full market cycle. While you can only get the market return, you can feel fully relaxed about your financial future, and spend more time on your health, learning and enjoy all the fun and happiness in life. However, if you really want to achieve investment success with less time, you have to take great efforts. It's not that you can take some effort to reduce the required time. It doesn't work that way, because so many other investors are trying their best for success. If you are determined to make an effort, you may have to go all in and try your best. Let's have an example of a successful investor. Peter Lynch is an American investor, mutual fund manager, and philanthropist. As the manager of the Magellan Fund at Fidelity Investments between 1977 and 1990, Lynch averaged a 29.2% annual return, consistently more than double the S&P 500 stock market index, and making it the best performing mutual fund in the world. During his 13-year tenure Assets under management increased from 18 million United States dollars to $14 billion. Peter Lynch believed in picking stocks one by one after thorough research, rather than expecting a speculative platform to throw open a list of good stocks. Instead, take one stock at a time and get acquainted with the company and the industry. He insists on knowing how the company plans to expand, cost pressures, pitfalls, and abilities. Peter Lynch also kept the following points in mind when selecting stocks. 1. First, you are investing in a predictable industry, where sudden trends won't easily shake and won't attract much market competition. 2. The company is growing convincingly. 3. The company has a niche of happy and satisfied customers. 4. The company is well known but not to an extent where all the analysts talk about it. 5. If the products are in demand. 6. If the company is buying back shares because it shows that the company has a strong cash flow position. 7. Over-diversification just for diversifying can land you in trouble, even more when you are not familiar with that many companies and industries. Peter Lynch has spent lots of time on analyzing stocks, day after day, year after year. He retired at the age of 46, which was significantly earlier than other fund managers. If you would like to make great profits within a short period of time with low risks, you need to do all the following tasks. 1. Always learn. Learn some macro analysis, fundamental analysis, technical analysis, and cycle analysis. Macro analysis is about the economy, fiscal and monetary policy, interest rate, inflation and employment, etc. If the macro environment is not looking good, you need to be careful. The most important thing is liquidity in the market. Fundamental analysis is about company strategy, industries, competitors, and markets, leadership, financial statements, operating efficiency, and valuations, etc. If you understand the company you are trading, you have a better edge to win. The most important thing is company valuation. There could be many hidden values in the financial statements. Technical analysis is about chartings, patterns, trends, indicators and overlays, etc. It's very useful to understand the trend and predict the future of price movement. But sudden fundamental changes and big money can change the trend. The most important thing is to know whether it's trending or oscillating, let the profit run and cut the loss quickly. Cycle analysis helps you understand the long-term patterns and trends. For stocks, there are accumulation and distribution cycles. For the stock market and economy, there are boom and bust cycles. During a lifetime, you could experience 3 big economic and stock market cycles, where you could have a chance to change your life. There are also some important concepts that you need to know. PEG, price earnings to growth ratio, is a valuation metric for determining the relative trade-off between the price of a stock, the earnings generated per share, or EPS, and the company's expected growth. A stock with lower PEG less than 1 is potentially a good candidate. Intrinsic value. Intrinsic value is a core concept that value investors use to uncover hidden investment opportunities. When a stock's market price is below its intrinsic value, it may be a smart investment. Margin of safety. When the market price of a security is significantly below the estimation of its intrinsic value, the difference is the margin of safety. Because investors may set a margin of safety in accordance with their own risk preferences, buying securities when this difference is present allows an investment to be made with minimal downside risk. Relative strength. Relative strength is a strategy used in momentum investing. It focuses on investing in stocks that have performed well relative to the market as a whole, or to a relevant benchmark. A stock with higher relative strength is usually the leading stock with a strong trend. AAII Investor Sentiment. Investor sentiment is measured with a weekly survey conducted from Thursday at 12:01 a.m. until Wednesday at 11:59 p.m. Tracking sentiment gives investors a forward-looking perspective of the market, instead of relying on historical data, which tends to result in hindsight bias. Fear and Greed Index. The Fear and Greed Index is a way to gauge stock market movements and whether stocks are fairly priced. Extreme fear or greed could cause the market to turn to the opposite side. Max Pain. Max Pain, or the max pain price, is the strike price with the most open options contracts, and it is the price at which the stock would cause financial losses for the largest number of option holders at expiration. Market makers get the max benefits when options expire at the max pain price. Accumulation distribution indicator. The accumulation distribution indicator is a cumulative indicator that uses volume and price to assess whether a stock is being accumulated or distributed. It seeks to identify divergences between the stock price and the volume flow. This provides insight into how strong a trend is. 2. Develop your own investment or trading system. Pick the right stock based on fundamental analysis, read stock charts and technical indicators. Timing for the entry and exit, set stop loss and stop wins, and with good money management. Have good discipline to execute your investing or trading system. You can refer to guru stocks, like what Warren Buffett is buying, or pick the leading stocks in different industries. You need to find the leading company with good fundamentals in the hot industry, and with a technical breakout with big volume. 3. Diversification. You can't put all your nest eggs in one basket. You have to find at least 15 stocks in different industries to make an investment portfolio. Each stock is totally different, so you need to do lots of work to make a balanced portfolio. 4. Keep learning. Summarize and learn from your mistakes. The stock market will always be changing, and there is no holy grail. You have to keep up with all the new developments in the world and technologies, if you really want to make great profits faster with low risks. But with less effort, there is an investing method called crash investing. For this method to work, there has to be a market crash over 50%. When there is a market crash, you can even borrow no-cost or low-cost money to buy. Eventually it will recover. When this happens, you can easily get at least 100% returns within a short period of time. However, you have to wait for it to happen, and you need to wait for the market to recover. It could be too random to be effective. Similarly, if you invest in the S&P 500 Index ETF, you could just accidentally buy at the market bottom and experience a super bull market. Then you could be much earlier than 30 years to achieve your objective. However, relying on luck is not an investment strategy.
Here are some recommended books for value investing.
You need to have some good knowledge about accounting, finance, and business before reading those books. The Intelligent Investor, by Ben Graham, who is considered the father of value investing. Common Stocks and Uncommon Profits, by Philip Fisher, who is another giant in the investing world. Warren Buffett says that his own investing approach is a combination of Ben Graham's and Fisher's. Beating the Street, by Peter Lynch, who is one of the most highly regarded investors on the planet. You already know about his story here. Margin of Safety, by Seth Klarman. All value investors understand the importance of the margin of safety. Value investing from Graham to Buffett and beyond. This is a good summary of different value investing approaches. For technical analysis, there are more books than value investing. Here are some recommended books for technical analysis. Technical Analysis of the Financial Markets, a comprehensive guide to trading methods and applications, by John J. Murphy. Technical Analysis Explained, The Successful Investor's Guide to Spotting Investment Trends and Turning Points, by Martin J. Pring. Market Wizards, Interviews with Top Traders, by Jack D. Schwager. You should also know about Dow Theory, W.D. Gann, and Wyckoff Method. Lastly, if you really want to take some high risks for making fast money, you can short highly speculated stocks when they reach peak price. Sometimes, there are some stocks without any fundamentals that multiply the price in a short period, like a few days. You can try to short or buy put options if available. The return can be really good. However, you may experience a short squeeze, which may result in big losses. Short squeeze is a kind of manipulation, which is hard to predict. That's why it's a high risk and high return strategy. Day trading could be another fast way to make money. But it's basically a full-time job. Can take lots of time and effort, and can also cause lots of stress, which is not good for your health. Now you understand all the important things for stock investment. You can make decisions based on your own circumstances. Good luck to your stock investment journey. Blue Eden Project can help you find all the best solutions and great ideas for a balanced life. Join Blue Eden Project, achieve a better life, and build a better world. Thank you for watching.